Today we will discuss about the liquidity management. What are the procedures adopted by the Reserve Bank of India to maintain liquidity in the economy, or liquidity management of the banks are explained. First of all, what is a liquidity management? Liquidity management is the operating procedure of monetary policy and which seeks to ensure adequate liquidity in the system so that sufficient credit is provided to all productive sectors in the economy. That is, liquidity management is the operating procedure of monetary policy, and the aim is to ensure adequate liquidity in the system. For what? In order to provide sufficient credit to all productive sectors in the economy. This is the liquidity management. And the first step in this process is it is a process. It is a process, and here the first step in this process is the transmission of changes in the policy rate to the interbank call money rate. Subsequently, this impulse get transmitted to long-term interest rate on financial instrument traded in markets, loans and deposits. The first step of the liquidity management process is the transmission of change in the policy rate to interbank call money rate, that is short-term rate, and this impulse get transmitted to long-term interest rate on financial instruments traded in the market, loans, deposits, etc. Liquidity management is premised on the principle that banks are required to hold at the end of the day a certain level of cash in their account with the central bank called required reserves. That is, the liquidity management is based on the principle that banks are required to keep a certain level of cash as required reserve with the central bank. As a bank's cash balance changes throughout the day, consequent to the customer's transaction, each bank's need for reserves at the end of the day is also uncertain. Since the demand for reserves has implication for the overnight interbank rate, which in many cases is the operating target of monetary policy that we have seen, central bank modulates the supply of reserves to achieve the objective of keeping the overnight market rate close to the policy rate. Here the point is that liquidity management is the operating procedure of monetary policy and which ensures adequate liquidity in the system, and it is to ensure sufficient credit to the productive sectors in the economy. And in this process, the first step is the transmission of changes in policy rate to the interbank call money rate, that is short-term rate. Then it will be transmitted to the long-term interest rate. Here a brief description about what is the concept of liquidity is given. The term liquidity has many different meanings. The term liquidity is used in three senses: funding liquidity, market liquidity and central bank liquidity in this context. Funding liquidity means the Basel Committee on Banking Supervision defines funding liquidity as the ability of bank to meet their liabilities, unwind or settle their position as they become due. That is, it is their capacity to meet their liability. Similarly, the International Monetary Fund IMF provides a definition of funding liquidity as the ability of solvent institution to make agreed upon payment in timely fashion. Thus, funding liquidity refers to the ability of individual institutions to meet their liabilities and other payment needs. That is, the funding liquidity is the ability to meet their liability. Second one is market liquidity. It refers to the ease with which the financial assets can be converted into cash at short notice. The second term is market liquidity. It refers to the ease with which the financial assets can be converted into cash at the short notice. The third one is the central bank liquidity. It refers to the reserves provided by central banks to the banking system. Banks are in many countries required to maintain a mandated level of balance in their account with the central bank. These balances are referred to as required reserves. If the banking system has less money than the required reserves, which it needs to borrow from the central bank, it is said that the system liquidity is in deficit and vice versa. The central bank liquidity operations accordingly refers to the injection or absorption of the reserves from the market banking system. The third concept is the central bank liquidity. It refers to the reserves provided by the central bank to the banking system. Banks are in many countries required to maintain a mandated level of balances in their accounts with the central bank. These balances are referred to as required reserves. If the banking system has less money than the required reserves, which it needs to borrow from the central bank, it is said that the system liquidity is in deficit and vice versa. If the banking system has more money, then the system has surplus balances. Central bank liquidity operation accordingly refers to the injection or absorptions of reserves from the banking system is referred as central bank liquidity. That funding liquidity means the ability to meet the liability. Market liquidity refers to the ease with which financial assets can be converted into the cash. Central bank liquidity means the capacity of injections or absorption of reserves in the banking system. The measures of central bank liquidity in India is given in this section. It is a key element in the monetary implementation process, and generally the banks would need to borrow funds from the central bank to meet their reserve requirements if they cannot meet from their interbank market and vice versa. If the banking system is a net borrower from the Reserve Bank under liquidity adjustment facility, the system liquidity can be said to be in deficit. The bank maintains a slightly positive margin, excess reserve of the required reserve on a daily basis to meet unanticipated settlement obligations or precautionary demand for reserves that needs to be reckoned to arrive at the quantum of liquidity available to the banking system on a given day. Liquidity can be summarized as the measures of central bank liquidity in India is given here. And the central bank liquidity is the key element in the monetary policy implementation process. And the important point for liquidity management operation is the banking system liquidity or the system liquidity. And the system liquidity equal to the net borrowing under liquidity adjustment facility minus excess reserves maintained by the bank. Net borrowing under liquidity adjustment facility equal to total of all repo, MSF, SLF borrowing minus total of all reverse repo deposits. And the excess reserve maintained by the banks equal to actual reserves maintained by the bank minus required reserves. This is the system liquidity. A positive figure for equation 1 indicate the system liquidity is in deficit, and negative would indicate the system is in surplus. That is net borrowing minus excess reserve is the equation. Therefore, negative figure shows the liquidity, surplus liquidity, and the positive means this positive means this will be higher, and therefore deficit. Evolution of liquidity management framework in India is given in this section. The liquidity management framework of Reserve Bank of India has evolved through progressive refinement since 1999 in response to the changing domestic conditions and global development. In April 1999, induced liquidity adjustment facility was introduced, and in which liquidity was injected against the collateral of government securities at various interest rate. And the transition from ILAF to full-fledged liquidity adjustment facility took place in June 2000. With the introduction of liquidity adjustment facility, steering overnight money market rate emerged as the key challenge in daily liquidity management operation. That is, the daily money market rate become an important rate determining the liquidity in the system. The liquidity adjustment facility was operated through the overnight fixed repo rate at which liquidity is injected, and reverse repo rate at which liquidity is absorbed from October 2004, consistent with the monetary policy objective. The liquidity adjustment facility became the principal instrument of liquidity management with an asymmetric interest rate corridor with repo rate as the ceiling and reverse repo rate as the floor, varying between 100 basis point to the 300 basis point. This also we have seen in the monetary policy mechanism, monetary policy instruments. As an additional instrument, the market stabilization scheme was introduced in April 2004 to aid sterilization operation as the security holding of the Reserve Bank was inadequate. The operating framework was modified in 2004, that is in 2000 liquidity adjustment facility was introduced, and in which the ceiling and floor rate were decided. After that, in 2004, the market stabilization scheme was introduced, and the operating framework was modified in May 2011 in pursuance of the recommendation of working group on the operating procedures of monetary policy headed by Dr. Deepak Mohanty, and the repo rate was made the single independently varying policy rate for transmitting the policy signals, and it was decided to keep the system in a deficit mode for efficient transmission of the monetary policy's impulses with the target monetary policy. A marginal standing facility was instituted under which the bank could borrow overnight at their discretion, dipping up to 1% into the statutory liquidity at 100 basis point. The report of the expert committee to revise and strengthen monetary policy framework headed by Dr. Urjit Patel recommended that excessive reliance of Reserve Bank of India on overnight segment of the money market should be avoided by de-emphasizing overnight repos, and suggested instead that liquidity management operations should be conducted through the term repos of different tenors. Accordingly, the committee recommended design changes and refinement in the operating framework with flexibility in the use of instrument but consistent with the overall objective of monetary policy. The key change in the framework was doing away with the unlimited accommodation of liquidity needs at the fixed liquidity adjustment facility repo rate. Other important elements of the revised framework include provision of the predominant portion of the central bank liquidity through regular term repo auction, introduction of fine-tuning operation through repo or reverse repo auctions of maturity varying from overnight to 28 days with liquidity assessment undertaken on a continuous basis, phasing out export credit refinance, etc. Here earlier it was in 1999, induced liquidity adjustment facility was there. Later on in 2000, liquidity adjustment facility was introduced. In 2004, market stabilization schemes were introduced, and all this, the market day-to-day money market rate was the determining factor. And report of the expert committee to revise and strengthen monetary policy framework under Urjit Patel recommended that excessive reliance of the Reserve Bank on the overnight segment of the money market should be avoided by de-emphasizing the overnight repos. And they have also given some elements, some suggestions regarding the provision of the predominant portion of central bank liquidity through regular term repo auctions, introduction of fine-tuning operation through repo, reverse repo auctions, phasing out export credit refinance, etc. In April 2006, when it was decided to progressively lower the average ex-ante liquidity deficit in the system to a position closer to the neutrality. The current liquidity management framework of the Reserve Bank of India is driven by two objectives: supply or withdraw short-term liquidity from the market so as to offset frictional changes in reserves. The first objective is met by smoothing friction. This objective is met by smoothing frictional mismatches through liquidity adjustment facility, including fine-tuning repo, reverse repo auctions of varying tenor to keep the system liquidity conditions closer to neutrality. The first objective is that to supply or withdraw short-term liquidity from the market so as to offset frictional changes in the reserves. That is, it is met by smoothing frictional mismatches through liquidity adjustment facilities to keep the system liquidity condition closer to neutrality. Second one is to supply durable reserves in line with the growing economy. This is made by modulating net foreign assets, that is, accretion or depletion of forex reserves and net domestic assets Purchase and sale of domestic securities through open market in a reserve bank's balance sheet in sync with the growth of the economy. This is the second condition. That is, the current liquidity management framework of the reserve bank is driven by two objectives. First one, supply or withdraw short-term liquidity from the market so as to offset frictional changes. Second one, to supply durable reserves in line with the growing economy. First one is met through the liquidity adjustment facility. Second one is met through modulating the net foreign assets. The guiding principle of liquidity management framework is given here. First one is transmission to target rate. That is, the second one is the liquidity management framework design. The first one is transmission to target rate. The appropriate liquidity management framework should enable transmission of monetary policy impulses to shortest end of interest curve by adequately meeting the system demand for the reserves. This is the transmission to target requirement. That is, the appropriate liquidity management framework should enable the transmission of monetary policy impulses to shortest end of interest rate curve. This is the transmission to target. Second one is liquidity management framework design, and there are broadly two types of liquidity framework: the corridor system and the floor system. In a corridor system, the central bank has the standing facilities to lend reserves and accept deposits from the bank. And in the floor system, the key policy rate is equal to central bank's deposit. That is, the lower bound of the corridor. The first corridor system, central bank has the standing facilities to lend reserves and accept deposit. Second one, the key policy rate is equal to the central bank's deposit rate. In flow system, the interbank rate become insensitive to the supply of reserves, as the central bank could supply any amount of reserves to the banking system without having any impact on interbank rate. Under the flow system, the deposit rate becomes the effective policy rate. Here, in the corridor system, the central bank has the standing facilities to lend. On the floor system, the key policy rate is equal to the central bank's deposit rate. And in the floor system, the interbank rate become insensitive to the supply of reserves, as the central bank could supply any amount of reserves to the banking system without having any impact on the interbank rate. And the principles of liquidity operations are explained. The principles include liquidity management framework should be guided by the objective of maintaining target rate that we have seen. The first principle is the transmission to target rate. That is the rate in the interbank market for reserves close to the policy rate. That is, the rate in the interbank market for reserves should be closer to the policy rate. Then second one is the central bank provides the reserves through its liquidity management operation to eligible entities. The target rate is usually the rate at which reserves are borrowed or lent among banks. That is, the call money rates in India. The second principle is that the central bank provides reserves through its liquidity management operation to the eligible entities. The target rate is usually the rate at which the reserves are borrowed or lent among banks. The third one is that the effectiveness of liquidity management operation requires high degree of efficiency in the interbank market for central bank reserves. That is, banks are free to borrow and lend in the intermarket rate. The first one is the interbank rate for reserve must be closer to the policy rate. Second one is the call money rate in India. The liquidity management operation to eligible entities, the target rate is usually the rate at which the reserves are borrowed or lent among themselves. Third one is that banks are free to borrow and lend in the interbank market. The next one is the central bank should provide liquidity via open market operation and the bank should allocate it among themselves. It is important that liquidity management framework doesn't undermine the price discovery process in the interbank money market. The framework should incentivize banks to trade among themselves rather than with the central bank. Operationally, this implies that generally banks should be able to borrow in the interbank money market rates not higher than the rate at which they would borrow from the central bank. The rate at which the central bank absorbs liquidity and the rate at which the inject liquidity should not materially be the same, as it changes the incentives in the market, thereby affecting the price discovery. And the principles of in this section, the principles of liquidity operations are given. The first one is that the liquidity management framework should be guided by the objective of maintaining the target, that is the rate at which interbank market for reserves close to the policy rate. It should be guided by the target rate. The second one is that central bank provides reserves through its liquidity management operation to eligible entities. The target rate is usually the rate at which the reserves are borrowed or lent among themselves. And the second one is the banks are free to borrow and lend in the interbank market. Next one is that the central bank should provide liquidity by open market operation and the bank should allocate it among themselves. Then next point is the principle is that it is important that liquidity management framework does not undermine the price discovery process in the interbank money market. And another one is that the framework should incentivize banks to trade among themselves rather than with the central bank. Then next one is the rate at which a central bank absorbs liquidity and the rate at which it inject liquidity should not materially be the same, as it changes the incentives in the market, thereby affecting the price discovery. And there is recently the report on liquidity management in India has given certain suggestions regarding the liquidity management process. They are the current liquidity management framework should largely continue in its present form. A corridor system with the call money rate as a target rate should be introduced. And another one is framework should be flexible. While the corridor system would normally require the system liquidity to be in small deficit, if the financial condition warrant the situation of liquidity surplus, the framework should be adaptable. That is, it should be flexible. Third one is minimizing the number of operations should be an efficiency goal of liquidity framework. There should be ideally one single overnight variable rate operation in a day, supported by the fine-tuning operation if required. And next recommendation is the current position of assured liquidity up to 1% of net domestic time liability is no longer necessary, since the proposed liquidity framework would entirely meet the system's liquidity needs. Build-up of a large deficit or surplus, if expected to persist, should be offset through appropriate durable liquidity operations. Daily dissemination through money market operations. Press release should be improved by including flow impact of liquidity operation. To improve transparency, quantitative assessment of durable liquidity conditions of the bank system may also be published. These are some of the conditions or some of the recommendations provided by the working group on the liquidity management by the RBI. That is, the current liquidity management framework should largely continue in its present form. Framework should be flexible. Third one, minimizing the number of operations should be an efficiency goal of the liquidity framework. Current provision of assured liquidity up to 1% of net domestic time liability is no longer necessary. Build up of a large deficit or surplus, if expected to persist, should be offset through appropriate durable liquidity operation. The next one is the daily dissemination through the money market operation, that is through press release, should be improved. These are some of the suggestions here. This liquidity management is the process. Liquidity management process in India is given. It is the operating procedure of monetary policy, and it ensures adequate liquidity in the system, and it is functioning through the policy rate, day-to-day interest. It is functioning through the day-to-day interest rate, and thereby transmitting it to the long-term interest rate. The liquidity management principle requires that the banks are required to hold at the end of the day a certain level of cash in their record with the central bank, called the required reserve, and the term liquidity concepts are explained, and the measures of liquidity in India is given. Then guiding principles are explained. principles of liquidity operation, that is liquidity management framework should be guided by the objective target rate. Then the effectiveness liquidity management operation requires high degree of efficiency. Provide liquidity, central bank should provide liquidity, etc. These are some of the principles and some of the recommendations by the recent working group on liquidity liquidity management are also given in this section. That is, this liquidity management is the process through which the goals of the monetary policy can be materialized.